Okay, so we've got our last two chapters, which we're stepping away from individual tax, and we're going to talk a little bit about two different types of business organizations. So for purposes of reporting business income and expenses, so far we've just talked about the Schedule C that is part of the 1040. These are different business organizations that have their own tax returns. So the income, well, for a partnership, because it's a flow-through entity, and we talked about flow-through entities in Chapter 8, we talked about flow-through entities and what they are. Partnerships are a type of flow-through entity where the income and expenses will flow through to the owners, the partners of the partnership, and that is treated like it's as though it is self-employment income, but it's been reported a little bit differently. But the partnership itself has its own tax return. It has a form called a Form 1065. So instead of a Form 1040, this is a Form 1065. So for individuals, oh, that doesn't work. Let me see if I can find one that works. Maybe one of these. That doesn't work. Wow. Maybe it's the board. So individual taxpayers, we have the Form 1040 that we have been learning about, and all the different schedules and additional forms that feed into that Form 1040. But the 1040 is the form that we use for individual taxpayers. For partnership, they use what's called a Form 1065. So the Form 1065 operates as like a really complex Schedule C. It reports all of the income and expenses, and partnerships are actually quite complicated. There are all sorts of different rules related to partnerships, and there are some accountants, CPAs that's all they will do is partnerships, so that they become specialized in the accounting for partnerships. We're not going to go into a lot of the details of partnerships. We're going to talk about how a partnership is formed, and how we report income and expenses, and how a partnership is dissolved. But more than that, we're not really going to go into a lot of detail more than that. This is just a really high-level conversation about partnerships in general. Then we have C corporations, not to be confused with Schedule C, but these are entities that are incorporated. So if it's got INC at the end of the name, Inc., then it is incorporated. C corporations use what's called a Form 1120. What am I doing? 1120, that's the form that they operate with. Corporations have, and we're going to talk about corporations in the last chapter, in Chapter 15, again, at a rather high level. C corporations are actually a little bit easier to deal with than partnerships are. But they've got their own kind of, not really set of tax rules, but they have some specific reporting rules that are specific just to them. We have also this kind of entity. We have what are called S corporations, and they file on a Form 1120S. An S corporation is kind of a hybrid between a partnership and a C corporation. It's got some of the features of a partnership, a lot of the features of a partnership, but it's still a corporation. It's not a partnership. And whether or not an entity is a corporation or not depends on how they've organized under state law. So state, in Iowa, it is the Secretary of State that oversees business entity organization. And when you become a business, you go to the Secretary of State and you register as a particular type of entity. There are certain liability protections that are offered as a corporation. It's like you're separated legally from the activities. The individual is separated legally from the activities of the corporation. With partnerships, unless you are organized as a limited liability partnership, you are liable. You're personally liable for the activities of the partnership. You don't have that separate legal protection that is offered with corporations. Now, there is another type of company, and limited liability companies. I'll write it out. Now, a limited liability company is a company that is recognized under state law. It's not really recognized for tax purposes. The IRS doesn't have a special tax form for limited liability companies because a limited liability company could be a sole proprietorship. You could be organized as a sole proprietorship. It could be a partnership. And it could be an S corporation. These are the tax entities that could exist for a limited liability company. So the IRS doesn't, like I said, they don't really recognize limited liability company as a separate tax entity. It is a legal entity. And what it does is it allows one of these types of companies to limit the amount of liability that they have personally for the company. So they're usually used for sole proprietorship or a partnership. You'll also see LLP, limited liability partnership. You'll see different abbreviations, kind of different names for it depending upon the state. In Iowa, we use LLC. I think there's an LLP as well. But for our purposes, for this chapter, this is what we're looking at here, are these partnerships. And we'll look at the Form 1065, which, like I said, acts as kind of like a glorified, really extensive Schedule C. So it's an income statement, but as part of this tax return, there's also a balance sheet that goes along with it. And that can create some complexities to it because the balance sheet that's used is the financial accounting balance sheet, but we're talking about tax laws. And as we already know, financial accounting is different from tax accounting. And so there's some nuances there. But in this chapter, so what we're going to do is talk about how we form a partnership, what it takes to form a partnership, and what a partnership is treated like an asset. So you're creating an asset, you're creating a business, and you're creating an asset, and that asset has a basis, just like every other type of asset. A partnership has a basis to it. So we're coming back to talking about basis, but there's a little bit of complexity added here because we have what's called an inside basis for the partnership and an outside basis. So we'll discuss what exactly that means. We'll look at how we report partnership incomes or losses. Again, that's our income statement there. We'll go back to talk a little bit about those separately stated items. If you recall that Schedule K1 that is issued for flow-through entities, remember we've got our ordinary income, but we have a bunch of boxes that are available for separately stated items, things like dividend income, rental income, royalty income, anything that would be reported differently on the Form 1040 in a different place would be reported separately on that Form K1. So that's what we're going to revisit there. separately stated items. We're going to talk about partner basis and the calculation of partner basis. So each partner, like I said, it's an asset, and it's an asset to each partner. And so that partner has a basis in their partnership, and there are certain activities, things that happen throughout the year that increase the amount of basis that an individual has in the partnership, and things that happen that decrease the amount of basis that they have in that partnership. So we're going to talk about how that is calculated. Also, rules for distributions from partnerships. So when a partner removes assets, could be cash, usually it's cash, from the partnership, talk about the rules for how that's treated when that happens. And then the last part is how we report partnership liquidations and dispositions. So liquidations, when a partner, when the partnership liquidates, it's no longer in existence. Dispositions, that's when one of the partners gets out of the partnership, leaves the partnership. How is that treated, and how does that affect all of the features of the partnership? So that's what we are going to look at in this chapter. We'll get started here.